Welcome to lesson 1, part 6 of the 8 stock investing categories. I'm your teacher and mentor, Mntom'nyama. We now move on to the last and most simple category to invest in, that is exchange traded funds, namely ETFs. The good thing about ETFs is that you don't have to pick individual companies, which means one does not have to calculate the intrinsic value of the business. You don't have to go through financial statements, nor is there any company-specific risk. This is because an ETF is a basket of companies grouped together. More about that in later lessons. We buy based on technical analysis, such as trends, moving averages, support and resistance, and according to PE or PEG ratios. Or you can just buy a fixed amount of contracts at regular intervals, which is called dollar cost averaging. So you can buy either country-specific ETFs, sector and industry ETFs, bond ETFs, or commodity ETFs. So how do I decide whether to buy shares of an individual company or buy an ETF? Simple. I only buy shares of companies which are industry leaders, companies that are a monopoly, having little or no competition. In these cases, I always buy the individual business. There are certain industries that have a lot of potential for growth, but there is not one company that dominates that industry because the industry has a lot of competitors. It is a highly competitive industry. For example, we have biotechnology, electric vehicles, robotics, artificial intelligence, to name but a few. To invest in these industries without exposing oneself to a single company risk, it is better to just buy an ETF of these companies. You just buy all these companies grouped together in the form of an ETF. It is much safer to do it that way because in a highly competitive sector, it is difficult to know which specific company will ultimately prevail over the others. Now let's have a look at the different strategies one can use to invest in ETFs. You can either invest in a passive way, meaning you just buy and hold for the long term, or you can invest in an active way by buying and selling according to price trends, which is like buying and holding in an uptrend or selling in a downtrend. Let's have a look at the first strategy, buy and hold market index or sector ETFs. Simply just buy the ETF at regular intervals by dollar cost averaging, buying dips on an uptrend. This buy and hold strategy could yield returns of 10 to 12% per annum if you look at US and China indexes. And as always, be prepared for temporary drawdowns or market dips of up to 20 to 50% during bear markets. Remember, no trend goes up in a straight line. There will always be dips, so you just close your eyes, you hold during these drawdowns. The second strategy is trend following market index or sector ETFs. In this strategy, you just follow the trend, meaning buy when there is a dip in an uptrend or when the price is reversing into an uptrend. This is when the 50 moving average crosses above the 150 moving average and both lines sloping up. When do we exit? We sell when the price turns into a downtrend. In other words, the 50 moving average crosses below the 150 moving average and both lines sloping down. One can expect returns of 15 to 20% per annum on this strategy. And this is for US and China stocks. Now, the third strategy is focusing on secular growth sectors or industries. So if you don't want to buy the entire market or index, one can just focus on a specific industry that is growing at a good rate, like electric vehicles, solar energy, healthcare, robotic, artificial intelligence, cybersecurity, cloud computing, e-commerce, to name but a few. And on to the last strategy, where we focus on undervalued sectors or industry hit by temporary bad news. Sometimes a particular sector or industry will be hit by a recession or temporary bad news that causes the entire sector or ETF to become undervalued. It is during these situations where we take advantage and accumulate more contracts.